I'm making a video. You want to be in it?
What is it?
Come here, I'll show you.
How?
Look. Yeah. What time is it? What time is it? You gotta do your what time is it thing. What time is it?
Tom.
What time is it?
Tom.
Alright, so the Bank of Canada raised the overnight lending rate by 0.25% today to 0.75. Yeah, that's right, 0.75%. Big deal or not? Well, the answer is no, not really. No, not really. So it might seem like a big deal because this is the first time they've changed rates in about 7 years. But the impact it's going to have is going to be almost nothing. So here's the changes that are going to happen and the real effect that it's going to have. First of all, prime rate at the banks is going to go up to about 2.95%. It was at 2.7. What this means is if you have a variable rate mortgage, a variable rate line of credit, the interest rate's probably going to go up by about 0.25%. So on $100,000 or for every $100,000 you owe, it's going to cost about an extra $250 a year. For most people, not a big deal, right? If you're getting a variable rate mortgage today versus let's say 6 months ago, the rate's almost the same. So at 2.95% with today's discounts, which are about prime minus 0.7, you're paying 2.25%. Back in November last year, you're paying 2.7% on the prime rate, but your discount was about 50 basis points. So you're paying about 2.2%. So those rates are still pretty much the same. Whether you got a variable back then or whether you get a variable right now, you're probably getting pretty close to the same rate. Now if you did get a variable rate back then, your interest rate is going to increase by about 0.25%. But what you do is you go and you just refinance into the lower discounts and get the lower rate that's consistent with today. Back in November, fixed rates, 5-year fix was running about 2.59%. Today we can still get a fixed rate at 2.59%. So those rates really haven't changed. Now, the lock-in rates that you might have to pay if you go to lock in your mortgage, those have probably changed. In fact, they've probably gone up drastically. But for the most part, everything's still pretty much status quo to the way it was 6 months ago. So here's the question on everybody's mind who's going to be getting a mortgage in the near future. Do I go variable or fixed? And don't worry, for those of you who already have a variable rate mortgage, we'll get to you in a minute. But for those who are thinking about getting a mortgage in the next little while, the question is, do I go variable or fixed? Variable or fixed? Variable or fixed? Well, when interest rates are rising, people tend to jump to the fixed rate as the best option. But that's not necessarily the case. There's a guy out of the Schulich School of Business, Mosh Malevsky, that's the first time in my entire life I've said that whole thing correctly, who did a study based on variable versus fixed rates. The study looked at what the key factors were in saving money on a mortgage. What was the conclusion? The conclusion was this. It didn't matter the direction that interest rates were going. What mattered was the difference between the fixed rates and the variable rates at the time you got the mortgage. Taking the variable rate 100% of the time when the variable rate was lower was the right thing to do. Taking the variable rate 100% of the time when the variable rate was lower was the right thing to do. Now why is that? Let's think about it. If you can get 2.25 today on a variable rate, but you're going to have to pay 2.6% or 2.9% on a fixed rate, well, those savings when the mortgage is the biggest, they add up, and they add up drastically. Not to mention the fact that this move, this 25 basis point increase, it might be something that continues. Interest rates may rise consistently over the next little while, or they may fluctuate. They may go up for a little bit, then come back down, then fluctuate up and fluctuate back down. And more than likely what will happen is if you have a variable rate mortgage over the life of your mortgage, you're probably going to succeed. You're probably going to beat the fixed rate almost every time. In fact, the only time where fixed rates win is when they're lower than the variable rate when you got the mortgage. And that's only happened 3, 4, 5 times since the 1950s. So right now, with variable rates still being lower, I'd take the variable. Forget the fixed. In fact, in a couple of weeks when we go to renew our mortgage, that's what we're doing. Because we made the mistake 5 years ago of getting the fixed. The worst part about the fixed rate mortgages is the penalty. They're massive. So let's talk about the people who already have a variable rate mortgage. What should we do? Should we lock in? Well, no, I don't think locking in at this point is the right move. your rate is probably still substantially lower than what your lock-in rate's going to be. So again, take the lower rate. The other thing is, the bond market already priced in this move by the Bank of Canada. It was no secret that interest rates were going to go up. So in the bond market, interest rates went up. Subsequently, all the fixed rates went up too. So if you're locking in at today's fixed rate, you're already locking in at a higher rate than what it may come down to in the next week, month, or even the next year. So I'd hold off for a minute before you start making any decisions about, locking in what might be a really good product. The other thing you have to consider is that a 5-year fixed mortgage in Canada, it's essentially the same thing as a 5-year adjustable mortgage. Think about that for a second. Every 5 years, your mortgage adjusts. The rate you have today isn't going to be the rate you have 5 years from now. So the question is, do you want to go 5 years and then on one day, on your renewal date, have the interest rate jump drastically all at once? Or would you rather have it go gradually with a variable rate over time? I know for me, I'd rather have it happen gradually so I can get used to it than have it happen all at once on one day. The other thing that stands out in this whole Bank of Canada decision is that core inflation is only 1.3. And we typically don't see the Bank of Canada make moves when inflation's under 2%, but they've done that this time. So what that may be signaling is that they don't believe that this change is going to have a drastic impact. Normally central banks don't move their rates unless inflation's above 2%. So it's weird that they're doing this now. And I think what it is it's a clear signal to consumers that they shouldn't be borrowing. It's trying to make the borrowing more expensive. The one thing I do think is important to note is that this move might not be something that's going to change anything. In fact, the Bank of Canada might be making this move right now because they believe that a 0.25% increase in interest rates may have zero effect whatsoever. Because think about this, when rates are low, it really takes a lot of movement in interest rates to have a big impact, right? Like think about it, 0.25% on every $100,000, that's $250 a year. We're talking for the average person less than $25 a month. Not a big deal. Now, if it was 2.5% and we're talking $200 a month, you know what though? I don't think until we start getting up to rates of 5 to 7% that this is going to make a huge difference. In fact, I think for the very long future we're going to be in a low interest rate environment and we're going to see lots of little bumps up and down. And this is just that first little bump up. My fear is that the big effect is actually going to be this is going to scare people into the market. So think about that. If you're sitting on the sidelines right now, haven't bought a house, you're a young millennial, and interest rates are going up, housing prices are going up, what's the first thing you're thinking this morning? Are you thinking, oh no, interest rates are going to go up, I better stay out of the market? Or are you thinking, shoot, I better get the heck into the market? Because if interest rates go up and housing prices go up, I might be stuck out for good. So this may end up having the opposite effect that the Bank of Canada is trying to have. In fact, it might push more people into the market than out of the market. And that could be interesting. But regardless of what you think of interest rates and what you think of the housing market, one thing is true. You buy a home today and you hold it for the next 25 to 30 years, you're gonna be better off. So yeah, today, big changes, not so big. Not a big deal. Not something to worry about. At the end of the day, if you're going to be getting a mortgage, we still think variable is the way to go. If you've already got a mortgage, don't run and lock in. All you're going to end up with is a big penalty somewhere down the road. The one thing I would do if you have a variable rate mortgage is I'd look at refinancing and getting a lower discount if you're only at prime minus 50 or prime minus 40. And regardless of what happens, long run, if you're in the market, if you're buying property and you're not trying to time the market, you're going to do well. So don't worry about interest rates. Don't worry about this change. Just go out, buy the house, have a place to live that you like, that you can afford, and is within your means, and things will be good. I got sunburned.